Okay, recording has started. Fantastic. So I was talking about the analysis or type of financial statement analysis we'll be performing. So there are types depending on what we are asked in the examinations, and also we'll be learning the types that are practically applicable to financial statements to help us glean and understand what it takes. Most of them has been tested in most pathfinders or past questions by the examiner, but we're looking at the theoretical aspect and we'll be able to practicalize them when we come to any of those mock exams. So the various types include an external analysis. The first one is an external analysis. This is an analysis carried out by external parties to the entity, and the entity's published financial statements form the basis of this analysis. So what does this analysis mean? Now, for example, you work in an audit firm. Let's use maybe Gabriel Josiah & Co. is a medium-sized audit firm. Now, when you are analyzing the financial statements of Gongoni Nigeria Limited or Gongoni Nigeria PLC, this is an external analysis because we are not analyzing the financial statements of Gabriel Josiah & Co. Chartered Accountant. So it's an external analysis. And in the case study report, there are internal and external reports. We'll be looking at that in chapter 6, writing a professional report. Okay, sorry, chapter 7, writing a professional report. The internal report and the external report when we get to that. So the external analysis is like that. It's carried out on an external company to the entity you are working with. Now, there's also the internal analysis is carried out by the entity's financial manager. So, for example, I work with Gabriel Josiah & Co. I'm carrying out the analysis of my company on behalf of my supervisors or my board or a director or a senior person to provide information for decision-making to top management. So those are the key types of financial statement analysis, the external and the internal. And this graphically tells us how the reporting format is. And this explanation is graphical. We have the internal and the external report, and we'll be looking at that subsequently. We also have short-term analysis. It's concerned about analyzing the company's working capital. So short-term analysis looks at your day-to-day expenses, how you run the company month to month, year to year. So the short-term analysis is concerned with the entity's working capital, which has to do with your current assets and your current liabilities, how you're able to balance them. And it's advised that your current assets should be twice your current liabilities to enable you determine the short-term liquidity and cash position of the entity. So if your current asset covers your current liability by 2 times, that means you are doing well. Or if it's less than that, if it's 1 to 1, it's a bit risky. So this analysis is short-term, and we'll be looking at that in detail when we get to that aspect. So the short-term analysis shows whether the entity will be able to meet its short-term cash commitments, its solvency, short-term solvency. Now, aside the short-term, we're looking at the horizontal analysis. This involves, if you notice, there is no long-term analysis because the long-term analysis is covered in the long-term solvency ratios we'll be looking at. So the short-term analysis is important to get the business running on a day-to-day basis. Now, the next one is the horizontal analysis. This involves comparing or a comparative analysis of the financial statements for a number of years. It is also known as dynamic analysis. So for a number of years, let's look at 2020, 2021, 2022, 2023, 2024. That is horizontal analysis. You are looking at what they've done for those 5-year period. It could be 3 years, it could be 10 years. It is horizontal. And it's called dynamic analysis. You are comparing year by year what they've done based on each parameter or component of whichever of the financial statements you're talking about. So it could be comparing the revenue for those years. You could compare the cost of sales for those years. You could compare the gross profit. So any component of the financial statement or the statement of financial position for those years, year by year, you just pick maybe the non-current assets. You're comparing property, plant, and equipment for 5 years. So this is horizontal analysis and is a dynamic analysis. We have the vertical analysis that involves calculation of financial ratios based on a single year's financial statement. It is known as static. So we are looking at revenue as the base. So vertical analysis is up, down. Horizontal analysis is straight. So up, down means you're looking at the revenue as a percentage. So revenue is 100% as a base. Cost of sales, what is the percentage of cost of sales to revenue? So if cost of sales is 40%, you have your gross profit as 60%. So that's vertical analysis, and you go down. So the bottom line will be the remaining, which is net profit, to be the remaining percentage that is left from revenue. We'll be looking at that in past question where he has tested practically to see how this aligns. So this is called static analysis. So the types of financial statement analysis, we looked at the external, the internal, the short-term, the horizontal, and the vertical. This helps us understand how to tackle any of the exams, though practically you need to practice this in a Pathfinder. I think in one of the exams, one of the mock we'll be carrying out or be practicing, there is something in this line which we'll be looking at graphically so that we'll understand the types better. You see, at times, it's good you practice questions to be able to apply this graphically, and in case you're presented with it in maybe the next case study exams or in the office, you'll be able to provide value or a solution to what you are asked to do. This is very practical. Okay, so that will be the end of Unit 5. We are running. We'll be stopping 9:55. We won't stop by 10. We'll stop 9:55, take questions. Then by 10, anywhere we stop, we'll continue in the next class with the same financial statement analysis in Chapter 2. So let's quickly look at techniques for financial analysis if we don't have any questions. So I think I'll be stopping after each unit to take questions, contributions, or comments. So if you have any questions, contributions after each unit, I'll just stop. You can go ahead. So do we have any questions for the types of financial statement analysis? Okay, I believe our silence means we don't. Okay, so let's go to techniques for financial statement analysis. Now, a number of techniques are normally employed. Oh, Aisha is having challenges joining. Her network is off and on. So sorry about that. Okay, so a number of techniques are normally employed in analyzing a business entity's financial statements. So these techniques include comparative financial statements. So we are comparing financial statements of an entity over a period of time, say 2 or 3 years. So comparative financial analysis or financial statements analysis is the examiner's favorite. He will always, in fact, most of the time, he brings 3 years financial statement comparison summary. So he always does 3 years, 3 years, 3 years for the past 2-3 diets. That's what he's been doing. So it's called comparative financial statement analysis, where you compare 2020, 2021, and 2022, 3 years. So this comparison looks at the income statement, the statement of financial position. So far, he has not tested cash flow statement. So far, for the 21 editions I've looked at, the examiner has not tested cash flow statement. So take note, maybe May 2025, you see cash flow statement requirement. It will ask you to analyze cash flow statement. That's one financial statement I don't like. Is in practice, I can see somebody's emoji smiling. Is in practice, I began to understand cash flow statement, but in school and throughout my ICAN training, I didn't like cash flow statement. So maybe he will test.
I don't like it though.
Yes, now. I'm telling you, my sister, even me, I don't like cash flow statement. In school, I hated it. Any exam, I'll be praying, please, 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 I don't want to see cash flow statement. I don't want to see it. So who knows whether you test it, but it's very interesting. Yeah, go ahead. Go ahead, please. Let me hear your thoughts.
It's like the one that comes out practically is more easy. It's more easier than the one that comes out in exams, right?
Yes, that's true. I think so too. I think so. That's true. Because if you look at his questions, he has not tested cash flow statement, and I don't want him to test it, because if he tests it, if you look at the diet where he tested in corporate reporting, he tested consolidated cash flow. That diet was bad. A lot of people feel that die because people don't like consolidated. Anything cash flow, people don't like because it's dynamic. Cash flow tests the income statement and the statement of financial position. So anywhere you've done gwari or we call it nuku in the financial statements, the cash flow statement will catch you. Because your cash and cash equivalent most of the time is supposed to tally with your statement of financial position, cash and cash equivalent. So looking at the investing, operating, and the financing activities, they are a bit technical, but then it's easy, though it's not simple, it's easy if we understand the dynamics of it. Okay, so let's continue the comparison of the income statement and the statement of financial position over the period provides meaningful information when compared to similar data of previous periods. So these two major components of financial statements are what the examiner has been testing for a while. So take note and don't leave the cash flow statement out. Though in the pre-scene, if he is going to test it, he won't bring it in the unseen. Of course, we will have seen it in the pre-scene to know that, okay, we expect cash flow analysis. You said
network is having issues.
Oh, okay. Me, I can hear you. I can hear you very loud. Can you hear us? I guess it's your network. Me, I can hear you. Can any other person hear me?
Oh, yeah. Yes, I can hear you.
Okay, fantastic. So it's AC Zacharias. Yeah, it's AC Zacharias network. It will come back. MTN has been a bit bad today. Okay, so looking at the comparison of similar data for prior periods is what techniques of financial statement is all about. So the comparison of the income statement enables a review of operational performance of the entity over a period of time, so as to draw conclusions as to the direction of the entity's performance. So when you look at an income statement from a best view, you'll be able to know where it's going to. When you look at its revenue, its expenses, direct, indirect, its organic expenses, its inorganic expenses, you should be able to tell the performance of the company and where it's going to from what you've seen. And that's a technique of performance. So when you look at revenue, for example, and you see that cost of sales is 30% and gross profit is 70%, you'll be like, no, this company is doing well. Then when you look at its indirect expenses, admin, selling, and it's able to come up with maybe 30-40% bottom line net profit, you'll be like, no, this company is well managed. Their performance is good. You'll be able to predict that if they continue in this line, next year they will do better if these factors are in place. So from those percentages, you'll be able to rate the company and predict their future. Draw conclusions that, the business is good. But where you see a business like a financial statement and analyze, I used to use it to teach, whereby the cost of sales was already higher than revenue, and the company was already reporting gross loss. You know that is big problem. If you look at Kedco financial statements, Kaedco, Kaduna, you look at JOS, most of their financial statements from revenue, you see gross loss, a very horrible situation. So in situations like that, you know that the bottom line is definitely negative. If from the direct, the first line, which is the revenue and the gross profit is already gross loss. I know some people are hearing it for the first time, gross loss on the call. When I look at their financial statements of these discos, I'll just laugh. I'll be like, no worries, because government is giving you people money. That is why you are reporting this rubbish. If you are on your own to run, you are commercialized, fully privatized, you will make profit by first. So analysis of financial statement helps you, and it's good to really, not because of exams, just go online and download financial statements and just keep flexing your analytical skills. It will help you very, very much. Okay, so conclusions and recommendations are very important to analyze financial statement. Also, the comparison of statement of financial position during the period reveal the effects of operations on the assets and the liabilities of the entity. So you are comparing the entities one or more two periods of the statement of financial position. You're looking at the increase in its assets, whether there's acquisition or disposals, whether there's increase in debt, the borrowed money, or there's injection of capital, equity. So you're looking at the movements and what has changed over a 3 3-year period or 2-year period. And that's one of the techniques of analyzing the financial statement or the statement of financial position. So you carry this out by determining the absolute and percentage changes in the composition of these two statements within the period. So like I just stated, I said you're looking at the percentage between the income statement variables or components, the revenue, the cost of sales, the gross profit. You also look at the percentage increase in each year. So for example, 2020, how did revenue grow in 2021, 2022? So those are the analysis and the comparisons you perform. In the income statement, in the position statement also is the same thing. You look at up, down, and horizontally how they've performed in each year and how the percentage grew or nosedived. Okay, so having looked at comparative financial statement or comparative financial statement analysis, we look at common size, another technique. This analysis is done by converting the figures of the financial statements to percentages. So when you are doing common size, you convert the figures to percentage. And for the income statement, the figure for revenue is taken as 100%. So that's the base, 100%. Then gross profit, I've explained that a bit. Gross profit will not be a percentage. What's the gross profit of the revenue? So where you have gross cost of sales, 30% of revenue, that's the cost of sales means the direct cost of bringing the service to the consumer. And the gross profit is what you get as your proceeds. In manufacturing account, that's direct cost. Then you have your gross profit, which is your
Can anyone hear him? No, I can't hear him.
No, I can't either.
His network is frozen. Some issues in network.
Either way, the network is messing up.
Blank.
Apologies, network is a bit challenging today. Okay, I believe you can hear me. Please confirm you can hear me. I'm back.
Yes, we can.
Okay, fantastic. Sorry about that break in transmission.
It's okay.
All right, thank you. All right, so we're looking at the common size analysis and we're talking about converting revenue to the base and having the other components as a percentage of revenue. So we express the other items on the income statement as a percentage to revenue. So from gross profit, from cost of sales, gross profit, admin, selling, operating profit, EBITDA, we look at depreciation and amortization, down to the bottom line, which is net profit. We look at that expressed as a percentage. Also, for the statement of financial position, the non-current asset or the total asset is taken as the 100%, while other items of the statement of financial position are expressed as a percentage. So the total asset is 100%. Now, from non-current asset, what's the percentage of non-current asset to that 100%? So is non-current asset 50 or 100%? It will tell us what the weight of each component of the asset is. So non-current and current, what are the weight? Then looking at capital, the total capital and liabilities as the base of the equity and the debt, and other components like retained earnings, reserves. So that's the base in performing our common size analysis. Okay, so the third technique is statement of changes in working capital or analysis of cash flow. The statement of changes in working capital provides information in relation to working capital and between the financial periods. The amount of working capital for each period is determined by deducting current liabilities from your current assets. So in doing your analysis of statement of changes in working capital or cash flow, you are looking at how much liability is included in the current asset. So if the current liabilities is above or are above your current assets, then you know you have issues with your financial or working capital, your day-to-day running of the business. Now, the explanation for this change is expressed by breaking the changes into the makeup of the total current assets. So from your inventory, your receivables, prepayments, cash, you should be able to break them to see that where is the chunk of the challenge coming from. And you should be able to make reasonable decisions from that analysis. Okay, so that will be for working capital, which is a short-term analysis. You're looking at how to run your business on a day-to-day basis very seamlessly. Okay, now the fourth technique is trend analysis. This is very important. As a matter of fact, the third component of your reporting is largely trend analysis, especially when it comes to financial statement analysis or requirement 1, wherever the examiner tests financial statement analysis. Under this analysis, a particular year is chosen as the base, and 100% is assigned to the figures in the financial statement for that year, especially the income statement. So when you look at the trend for 2021, 2022, for example, 2023, you want to see the growth or decline trajectory. That's what you're doing. So the base of maybe 2021 is 100%. If they've grown by, let's say, 50% in 2021, 2020 shows that 2021 was better, 2022, depending on the percentage, could be better or the best. So trend analysis is looking at how they've done over the 3-year period with the first year as the base. Are they growing or are they nosediving? Are they declining? This is key. And this analysis is very important to explain in words the calculations and the trajectory the business is going through. So any percentage change in relation to the base year is then calculated for the other years. Generally, the first year of the financial statement provided is taken to be the base year. Like I said, 2021 became 100%. Then in 2022, if they dropped by 10%, that means they did 90%. 2023, if they dropped by another 10%, they did 80%. So that's how you do trend analysis. And this analysis is key. It's very important among the other 3 we've spoken about. The board wants to know how they've done last year. The investors, stakeholders want to know how they've performed year in, year out. Okay, so trend analysis is used to determine whether the financial health of the business entity is improving or deteriorating. This is very important. So in your analysis, trend analysis is key. Your business performance, looking at the trends, will determine whether the result of the operations are improving or declining. And you see, improvement is what life is all about. If you are not growing, then you are declining. So if a business also is not growing, it's declining. When a child is born, it's expected the child should grow. So by the time a child is deteriorating, it causes concern to the parents. And this is what the business is all about. So when the business is a startup, maybe it has teething issues, no wahala. But by the time in the next 5 years, you are still reporting the same profit or you are dropping, then it calls for concern. it calls for concern. So improvement, like somebody said, the greatest room in this world is that of improvement. So the business should also portray that every year you should be growing at a percentage rate. Just like as human beings, we can never be babies again. So should some businesses be. You should never report a particular result again. It's going to call for concerns among stakeholders. You have left that, you've outgrown that. So for example, now you see me carrying Cerelac, I'm crying over Cerelac. That should call for concern. I've outgrown that. I shouldn't be asking my mother for Cerelac or baby milk. So that's exactly the picture I'm painting concerning a business. So improvement and growth is normal to living things and non-living things, and the same thing with business. So growing is the constant, and it should be. And when the business is not growing, then a chartered account, that's where we come in. We should sit down and analyze, and the case study exam will tell us this business is not growing. What do we do to inject actionable recommendations that would make the business go back to autopilot? Very important. Okay, and the fifth one is ratio analysis, which is very, very important. This is the most popular way, of course, and most of the exams always come with ratio analysis, and the case study is all about that. This is widely used for analyzing financial statements. Financial ratios show a relationship between the individual items or group of items of the entity's income statement and statement of financial position. So ratios don't really relate with cash flow statements, just one or two ratios like the cash flow to debt ratio. That's just a ratio that is not, and it's not a popular ratio, though we'll look at it when it comes to ratio analysis. But most ratios are between the statement of financial position and the income statement. They can be grouped under 5 categories, which we'll be looking at: profitability, liquidity or short-term solvency, activity, efficiency, or leverage, activity or efficiency, then leverage or long-term solvency, and we'll also look at shareholders' return or investment. So these are the 5 broad types of ratio analysis. So profitability is looking at the returns. What do they get in return for their investment? And liquidity is looking at short-term running of the company and how liquid they are to stay solvent in the short run. Activity and efficiency is looking at the turnover of how the business is able to work out its working capital, its current and current asset and current liabilities, and the activities and how many times they are able to turn around the components in that category. Leverage, looking at the long-term solvency and the mix between equity and debt, very key component of ratio analysis. Then investment is for mostly public listed companies, looking at earnings per share, dividends per share, dividend yield, dividend cover, earnings yield, and other components of the ratios. So ratios highlight the key performance indicators of a business entity. It reveals a lot about the changes in the financial conditions of a business. This is key. The term ratio refers to mathematical relations or a mathematical relation between 2 interrelated variables, and it establishes the relationship between 2 items expressed in quantitative form. So ratios are what we'll be looking at if you've been doing accounting from secondary school. Like I started doing accounting in SS1, 2, 3, entered university, I studied accounting. So I'm familiar with ratios, except if you are coming from maybe foundation, not an accounting background. So ratios shouldn't be an issue. It's a common calculation for accountants. And it's simply understood by 2 relationships. You can pick a component or a number from the income statement and that of the statement of financial position, or that of the statement of financial position and the income statement, and express them in quantitative forms with a result either in percentage or in times to draw out improvement or decline from the numbers or the percentage. Now, accounting ratios can be defined as the significant relationship between figures shown in okay, I just want to confirm I'm still on the call. All right. figures shown in the statement of financial position and income statement. Alan Mulvey, in his book, International Financial Reporting, page 3554, described accounting ratio as a measure of the relationship that exists between two figures shown in a set of financial statements. Exactly. Financial ratios assist us in the interpretation of financial statements. So that's not the goal. The goal of financial ratios is to assist and not the end in itself. So financial ratios are not the end because your calculations don't mean anything to anybody. You understand this as a chartered accountant. A medical doctor does not understand current asset divided by current liabilities. He doesn't know what that means. So your explanation and interpretation of these ratios is the end. So financial ratios are a means to the end. And the end is to make somebody enlightened on how his business or his performance and position is. And that is our job. So interpretation is very important. And in the case study, interpretation is what matters, not just the calculation of the ratios. So in comparison and evaluating the performance of the business entity, accounting ratio is a useful tool as it eliminates the problem of comparability using absolute figures. Exactly. So it's a tool you use to eliminate the problem of comparability, and also that same comparability will help you write a report or make decisions or profile solutions for decision making. So comparing and evaluation is very important, and that's what ratio analysis helps to do. Accounting ratios are also used as a means of comparing an entity's performance over two or more periods, as well as a means of comparing an entity's position over the same period. And the same entity can be compared in that industry. So maybe you're looking at banking and the company and other companies in the banking sector for that particular period. And of course, the industry average. So if the average of the banking industry is a particular percentage in revenue generation, once the company you are asked to analyze is below that average, you know the company is not doing well. So if, for example, GT Bank, Zenith Bank, which other banks again, are doing a particular percentage in profit or in revenue, if the bank you are asked to analyze, let's say Oceanic Bank of blessed memory, Oceanic Bank does not exist again. So if an Oceanic Bank is doing lower than that percentage that Zenith and GT is doing, then you know the bank is underperforming based on that industry average. So that's part of what ratio analysis enables us to analyze. Accounting ratios also are classified based on these constructed and general characteristics. We look at the ratios. We're looking at coverage ratios. They could be seen, ratio analysis could be seen as a type, which is coverage. So we have something like interest cover. How many times can your profit before interest and tax cover your interest? Interest in terms of the debt you are owing. So you're looking at your coverage ratios. So interest cover or dividend cover is an example of coverage ratio. Then return ratio is how much you're able to get back from your investment. For example, return on capital employed. You employed capital in the business. What is the return? Now, equity is provided for the business. What is the return? Asset are bought to run the company. What is the return? That's why the return ratios, like those 3 ratios I mentioned, we are measuring in percentage term. Then the coverage ratio are measured in times. How many times can you cover your profit? How many times can your profit cover interest expense? So these are graphical examples. I'll be looking at them in detail. Then turnover ratios, like activity or efficiency. How efficiently can you turn over your receivables? For example, you've sold items out in credit. How many times have you received the money back? Let's say accounts receivable ratio, account receivable turnover ratio. So your sales is the numerator and your receivables are the denominator. How many times has your sales covered your accounts receivable? So we'll be looking at that practically. And these components, percentage ratio, according to how they are calculated, will help you make decisions as to each component of these ratios and how they perform the business. So coverage ratio, like we said, interest cover ratio is an example. How many times interest on fixed capital is covered by the company's operating expense? We've spoken to that. And return ratio looks at the benefit accruing and the relationship between what you employed, resources employed, and the business you got in. So I stated 3 ratios: ROAS, ROA, and ROE are an example. So interest cover, dividend cover are an example of coverage ratios. We'll be looking at them and calculating them also practically to understand how they apply with a case scenario. Okay, so an example is the return on investment ratios, which shows the profit earned from capital invested. We've spoken to that. Turnover ratio, looking at how the company is able to make use of a particular resource to generate benefit, like inventory turnover. I talked about account receivable. So inventory turnover, how the company is able to commit inventory to generate sales in cash or in credit during a particular year. Then we have component percentage type of ratio and the various components of an item in a percentage term. So for example, gross profit to sales, total overheads, looking at a manufacturing company ratio to sales. Okay, so there are 5 groups of ratio that can be calculated from the income statement. We've talked about them. This group of ratios measure the operational performance and financial condition of the company. So the first group is profitability. I'll be looking at that in detail. We are looking at how the level of profit the company has generated from the capital invested in the company. Number 2, liquidity. We've spoken about that briefly. The ability of the business entity to meet a short-term obligation. That means day-to-day debts. Short-term solvency, we've spoken to that, and how it's able to convert its asset, inventory, and receivables to quickly, or convert them quickly to cash. These assets, normally referred to as liquid assets, are shown in the statement of financial position as current assets. And we also have them called, you can refer to them, a synonym is either circulating or working capital. So the ability of the company to utilize long-term resources in its day-to-day operations determine its working capital. So your current assets minus your current liabilities is a factor to determine if the company is solvent in the short run. Now, the differences between the current assets and the current liabilities is what working capital is called. All right, we also look at the third type of ratio, looking at efficiency and activity. We're looking at the business entities, a measure of how it utilizes its asset, utility or utilization of assets. And the fourth one is long-term solvency, how we are able to leverage the balance between mix, debt, and capital. So looking at equity, which is proprietary capital, there's also a ratio called proprietary ratio or equity ratio, and also debt, long-term liabilities, borrowings from external providers of capital is what long-term solvency or leverage ratios are all about. We'll be looking at that graphically in an example. So these provide information on the degree of a company's fixed financing obligations and the ability to finance these obligations. So if you borrowed money externally, you have the capital, the principal, and you have the interest to pay back. But if money is injected by the owners, you will not charge interest. You only get dividend, and it's good to have a balance. There are times when you need to borrow to expand the business, and when borrowing is too much, you are giving the company out to external financiers. We are saying, you that is the owner, you are not worthy of owning the company. And where a particular percentage based on control is achieved by external providers, you lose control of the company. You become a minority shareholder, which most business owners are trying to avoid. So balancing debt and equity is very important, and chartered accountants, that's where you come in. In our analysis in the exam, you should be able to understand when a company is highly geared or lowly geared, or where a company is balanced. It's part of the analysis we perform, and these ratios, looking at some of them, will help us perform this analysis very seamlessly. Finally, we have the investment ratios for mostly publicly listed companies. These ratios are of interest to investors and potential investors. They show the level of returns that an investor can expect if you invest in the business. They are also called shareholders' ratios. This is very important. Okay, so we have 14 minutes more. Let's look at section 2 of Unit 7, which is profitability ratios. We are almost running out of time. We may not be able to start the calculations to look at these ratios today, but let's look at the theoretical aspect before we take questions and shut down so that we can rest in this session. So maybe on Monday, we'll look at the calculation aspect and practical demonstration of these ratios with a company example to really enhance our understanding, and also how to approach the mock exams and the actual exams. So these calculations will help us, and they are essential and necessary to be able to navigate the case study exams very seamlessly. So the profitability ratios help determine how efficiently the company is using its resources to produce profit. It gives insight into the overall financial health of a company. So when a company is healthy, it shows that it's profitable. So it's like a human being. When he's healthy, he's profitable by eating and defecating normally. He's growing. He's as the years go by, the human being is developing from adolescence to an adult. That's how a business is supposed to be. It's supposed to be profitable year in, year out. And that shows the business is healthy, just like a human being is. So profitability ratios are crucial for assessing the business capacity to generate profits from its operations. So, and that's why it's the first component of the financial statement. That is why it's not last. The income statement comes first because it helps you understand the cost components, cost structure, and sustainability in the long run of the company. So the income statement or the profitability ratios help to facilitate this. Profitability ratios are often used by investors, management, and analysts to gauge business performance compared with competitors. So when you look at the SCI of the company in the FMCG space, business space, you are comparing maybe which company is an FMCG company now? You are comparing let me see, a popular fast-moving consumer goods company. You're comparing, what's this, locks? Who is the owner of locks? Which company does locks? PZ. You're comparing PZ maybe with Promasidor. So when you look at their financial statement, Promasidor are the producers of cowbell and other household goods we use that fastly move in the market. So when you compare those two companies and look at their financial statement, you'll see whether one is more profitable than the other. And when you do ratio analysis and you permutate some of these ratios compared to those two companies I mentioned, you can make decision on which one is more profitable than the other, which one you could invest or advise for investment based on that. So these financial decisions help you compare competitors in particular industries in that business space to help you make investment and financial decisions. So the main profitability ratios, one of them is the return on capital employed, and it's one of the main ratios that will help you express in percentage terms the capital invested in the entity. And the formula is clear, but it's 950 now. If we look at the formula, we may have to start calculating this night. So instead of stopping 955, do you mind if we stop here? This is 950, so that we can start the calculations on Monday. And hopefully, if we can calculate the 5 components of ratios with a graphical company example, we'll be able to understand these components practically and also align very well with understanding the dynamics on the ratio calculations. So let's stop here at section 2, profitability ratio, so that when next we come, we have 10 minutes at least. We just take questions, recommendations, and we close in this session. I hope that's okay with us.
It's fine. It's fine.
Fantastic.
Thank you.
In this short 1 hour, we've looked at 120 slides. So it's been a long...
Wow.
You can see the screen now. It's 120 slides
Yes.
we've spoken to. Yeah. So it's quite detailing and it's hectic, but then that's part of the sacrifices. So let's take questions, please. If you have a question, if you have an observation, let's talk about it in the next 5 minutes so that by 9:55, we'll go and rest. Let me see how many people are still on the call. I trust Julie. Julie is always... okay, we have 6 or 5.
Oh, I slept small. I'm not always.
You slept small.
Yeah.
My sister
I
is
also
not,
dozed off
it's not
a bit.
easy. It's not easy. It's not easy. After a hectic day, I understand, Jerry.
Yeah, and it's end of the month. You can imagine the reports to prepare. So
Exactly. The commitments are very, very demanding.
yes.
Yeah, well done. Okay,
Thank you.
so I hope the rest are not even sleeping, sir, because it's only you and Aisha that is talking. Others, I guess you guys are sleeping.
I'm sure.
We're not, no.
Oh, okay, you're not sleeping. That's fine. All right, let's take questions. Any question? You have 2 more minutes so that we can rest. I'm seeing Salmat. I'm seeing my namesake. I'm seeing Chidima. Okay, so do we have any questions so that we can shut down in the next 2 minutes? So we agreed in the last audit class to take 2 mocks. As we are thinking about our question, we agreed to take 2 mocks in a month. Is that okay with us on case study for audit to be taking 2 mocks in a month? So is it also okay to take 2 mocks in a month in a case study? Is that okay? Let's deliberate.
It's fine. You know
Or
what?
one.
You said you're having it.
Is 2 or 1? Which one is better for us? 2 or 1? Considering our commitments, maybe others are having other papers and all that, so we don't choke ourselves. But I think 2 is okay in my view. I don't know.
2 is okay.
Okay, yeah, in my view. What of others? Aisha, what do you think? Namesake, what do you think? Salmat, is 2 mock okay
Yes,
for us? Okay, fantastic.
I feel like it's okay, but then again, I don't know how it's going to be because I'm considering we have basically 4, how many classes in a week?
4 classes.
Okay.
Mm.
No, in a month, I wanted to say.
Okay.
We have 8 classes.
Exactly.
Yes, 2 exams. I'll be 2 mock. It's okay.
Okay, so 2 mocks you do. So what we'll do is we'll make the debrief or the question and the review time. We'll make it flexible so that when it's convenient for us, we can just look at the solution, especially the... Oh, okay. I saw Chidima. All right. I saw your chat. 2 is fine. Okay, that's good. Majority of us align with 2. So firstly, we'll be looking at November 2024. That's the first mock we'll be looking at, and that will be on the 15th. Yes, that will be 15th. So we'll release 15th. We'll release it. Then we'll be able to write you. So the mock will be like this. We'll provide the questions. Then you write your report and send to me privately before we look at the answers. Then I'll share my own solution and my thoughts on that. Then we move to another mock at the end of the month, like that. I think that's how we would run it. Okay, so it's 9:55. We have to stop so that we can rest. Any other question, contribution?